Hi, now let's work on some application on bond valuation after this theory. Well, I posted some applications for you, and as usual, you are going to work on your own on discussion questions after reading the PowerPoint, trying to learn, make sure you understand the theory behind bond and stock valuation correctly. We are going to take the time now to work on some problem solving. Let's start with one. We are going to calculate the bond value. This business has this business is going to issue bonds at $1,000 per value or face value at 10% interest. This is the interest the investor would receive every year, which is also called coupon payment. So the bonds will mature in 20 years. Compute the current price of the bond if the yield to maturity is, we have three scenarios. Now, before we even go into calculations, I want to explain to you some very important concepts behind bond valuations. So, when suppose I buy this bond today, I pay $1,000 par value, okay, and then what I am receiving is 10% coupon payment for the next 20 years. This is the data behind my investment. Now, you have to understand that this percent coupon payment for 20 years is not going to change. It's a contract. Okay, it's going to stay the same. Well, you can sell your bond, but whoever is going to buy the bond from you is still going to receive 10%, which is $100 for the remainder number of years. If you sell it in 10 years, they are still 10 years. It's a contract. This one stays the same. What's going to change in time is this yield to maturity or market interest. That's going to change. That's the one that the Federal Reserve System targets. Sometimes it's going to increase it, decrease it. It's changing. Okay, and the fact that this yield to maturity is changing is going to affect the price for your bond. So let's see. Let's take this case when the yield to maturity is 6%. That means new bonds that are issued today are issued at this 6%. Suppose you purchased this bond few years ago and you purchased when the interest was, this yield to maturity was 10%. So intuitively, if you want to sell this bond right now, are you going to sell it for more than 1,000 or less? Well, you have a valuable investment right now. It pays you 10%. So that means that you are above the current new bonds that are issued. So investors would like to buy this investment and enjoy 10% interest rather than 6 for new bonds. So every time the coupon payment in percentage is above yield to maturity, your price, you can sell your bond for more than what you paid for. It's a valuable investment. Even here, 10%, it's a little above 9, so probably the price is going to come up a little above 1,000. However, for C, now this is more valuable investment than what you have, so it's going to be harder for you to sell your investment because it's below the new market yield to maturity. So that's going to come up, the price of the bond is going to be less than 1,000. That's important to understand the concepts. So now just work through calculations here. Take 6% yield to maturity. This is the one that you are going to use with these appendixes. Appendixes always go together with this yield to maturity. Don't use the coupon payment with the appendixes. You only use the coupon payment to calculate how much is your payment per year. In this case, 10% times 1,000, $100, and that's it. You don't use it after that. After that, you use this number with the appendixes. Okay, let's start with this one. We have 6%. So your coupon payment is 10%, 100 every year for 20 years. Market interest yield to maturity is 6%. So this is what we are going to use with Appendix D because it's a yearly payment annuity. N equals 20, interest rate 6%. Appendix D. Appendix D, N equals 20, interest rate 6%. So that's going to be 11.470. 11.470 times 100, 1,147. And then you calculate present value of your principal, which is 1,000. You have to do Appendix B this time because it's one-time payment. Present value of 1,000, Appendix B. Now we have to get up here. Appendix B, N equals 20, interest rate 6%. That's my number, 0.312. 0.312 times 1,312. And then I add up these numbers because it's the present value of all future payments, which is annuity plus principals. So I can sell my bond for 1,459, which is much more than I paid for originally when I first purchased it, 1,000, because right now the new bonds only sell for 6%, while my old bond pays the new investor, if I want to sell it to that person, 10%. See how it works? So those are just the mechanics of calculation. 9% again. See, the coupon payment doesn't change, only the yield to maturity. It's still 100. And it's still N equals 20 interest rate, 9% this time. This is the one that we use for Appendix D. Appendix D, N equals 20, interest rate 9%. That's going to be the factors times 100, 912. For the principal, Appendix B, N equals 20, interest rate 9%. So then you add up these two numbers. So you see it's still a little bit above 1,000 because your coupon payment is 10%, while the yield to maturity is a little lower, 9%. Now for the last case, you are going to be, you see, below 1,000 because right now you have a higher discount rate, 13%, and it's above your coupon payment. So again, Appendix D, Appendix B, total here. So just I'm going to give you more practice on these calculations on bond valuation, and then we are going to continue with more on theory and applications.